G'day everyone, welcome to this rundown for global and Australian stocks for the 15th of November. And quite a lot has changed in a week. We had really positive conditions last weekend, and a lot of things have changed in the week, and the markets have responded quite negatively in the last 2 days in particular. So it really has been a pretty rapidly shifting picture. So let's have a look at what has been unfolding, both from a fundamental point of view and a technical point of view. So look, there's a lot of things that have changed, but these are the main ones that would impact on markets to my mind. First of all, the US dollar strength has pushed commodities down. So the commodities index, which includes gold, minerals, and also agricultural commodities, and it's pushed that to a 14-year low, and that's actually lower than where we were in 2008 at the bottom of the GFC. So that's just the extent to which central bank policies of printing money and cutting interest rates to effectively zero are completely distorting global financial markets, because there's no way that the economic circumstances are as bad or worse than in 2008, not remotely. Yet commodity prices seem to be implying that. So the conundrum that the US Fed has is that they want to raise interest rates, at least to express some confidence in the US economy, which I think, the US economy is coming first and it's daylight second. It's not that the US economy is all that strong. It's not. It's running along at around 2.5%, but it's certainly stronger than everywhere else. So the Fed wants to raise interest rates, but the reason that they've held off is because they and other central banks have been wanting to see some degree of inflation. The worst nightmare for central banks is deflation. And with commodities continuing to push lower, though, that's really preventing the inflation that they're seeking. So they want inflation and they want to raise interest rates, but they just can't get it. And part of the reason for that's the changes that have really occurred over the last 10 or 20 years, is the incredible level of technical innovation that's occurred around the world, which means we've now got a surplus of manufacturing capacity, and we've got a surplus of labour capacity because of those technological changes. And it's really that, more than anything else, that's preventing the normal sort of inflation pressures that you would normally expect. I mean, the way that the Fed has been printing money in Japan and China and Europe and the UK, they've all been doing it. Everyone was predicting back in 2010 and 11 that a massive breakout in inflation was inevitable with so much money printing. But what no one really picked up on was the degree to which we've got excess capacity around the world, and that's what's preventing inflation. So central banks have got a conundrum that they've never been faced with before, and how they handle that will depend on how markets progress over the next decade. Now, the other thing that changed in the last week is that energy stocks were smacked hard again, with oil down, and oil actually broke to slight new lows for this part of the cycle. And this is really unsettling for the whole market. Energy stocks, whilst you might say, well, what's energy stocks got to do with it? They do contribute to the sentiment of the market, and it really is quite unsettling, because people interpret that if the oil prices are so weak, that must mean that the economy is weak, and therefore that's going to affect all sectors and all stocks. Now, so far that's not been the case, and it's certainly not the case in the sectors that I really zero in on, as members know. The other thing that's changed in the last week is that we had terrific job creation numbers in the US the Friday before, so that was a great positive that I talked about last weekend. But in the last week, we've had some unexpectedly poor retail sales numbers in America, and that isn't consistent with some of the other things that we're seeing. But we must remember that the total retail picture is changing, and that whilst retail sales from traditional bricks and mortar stores might be falling, that there's actually an increase in the level of online sales. And so we're seeing companies like Amazon do pretty well. So maybe those retail sales numbers are being interpreted fairly poorly, but they certainly did contribute to the weakness on Thursday and Friday, which was quite significant. Now, the market reaction to the changes in the last week was initially positive. We had a strong surge on last Friday night, Friday the week before, which seemed to be saying that the market had changed its idea and was going to positively support a rate rise. But then through the week, we've had this abrupt turnaround, and we've gone from a large number of stocks which had managed to start trading. I think it was 82% of stocks were trading above their 50-day moving average. And now we've got quite a large number of stocks in the S&P, again, below their 200-day moving average. And that's not a good sign from a technical point of view. As a consequence of those retail sales numbers, the consumer discretionary sector was hit especially hard and disturbingly on fairly significant volumes. So this wasn't something that was just being done at the fringe in the selling. The volumes really were quite elevated in that sector. So that's really signalling a bit of an abrupt change in sentiment, because the consumer discretionary sector has been one of the strengths for this year, and particularly the last 4 or 5 months. So that really is quite an abrupt shift, and that is a little bit of a concern and bears watching. And of course, the final change in the week is just the shocking thing that's occurred in Paris, as I'm sure you've all seen. I've had a couple of questions about what impact I think that might have on the market. Look, it's hard to say what causes the market to do what it does in the very short term, but it's hard to see any sort of lasting impact. We might get a day or two of instability, such as we've seen with other terrorist events, but in terms of an ongoing significant contribution, I just can't see any relationship at all. But certainly, very sad for the French people. So summing it all up, looking at it from the big picture point of view, we've had scare after scare since 2009. I started making a bit of a list of it yesterday, and I just had such an extraordinarily long list, I gave up. So there's been just a huge number of potential scares. The bears have been trotting out all these instances, and it's failed to stop the bull market. The bull market is now in its 6th year, and there's still scare after scare being thrown up. Recent ones were concerns about China, and I'm sure there will continue to be plenty of scares. But the bottom line is that economic circumstances and the stability of the global financial system is far better now than it was in 2009. That's a fact. So despite all those scares, circumstances are better, and the market is way, way higher. And I think the other thing from my point of view is that the economy and the stock market never got ahead of itself. We haven't reached a point of excess. So the economy has obviously not got to a point of excess that would require rates to be raised. And the market, in terms of valuation, never really got ahead of itself. Yes, there are some stocks that are ridiculously valued on the high side, and they'll experience corrections inevitably. But the general market itself didn't get far enough ahead of itself that we would require a bear market to correct it. So I can say, with a pretty high degree of confidence, that tops in the market never occur when the crowd is fearful. It just doesn't, and it almost can't happen by definition, because tops are created when everybody is in the market, all the money's committed, people are exuberant, and the smart money starts to leave the market because of overvaluation. That's what creates a top. So when the crowd is fearful, as the crowd has been for most of the last 6 years, that means that there's no exuberance, there's no excessive valuations, and there's plenty of money on the sideline. And almost by definition, a top can't be created under those circumstances. However, I will say that this is where understanding your personal game plan is absolutely vital. Are you a short-term trader, or are you a longer-term investor? And it's incredibly important. I know a lot of people just sort of, their eyes roll back and they brush it off, but it's incredibly important to know who you are, Because if you're a short-term trader, then you need to be responding to what's happening in the market right now. You need to be cashing up a bit because we don't know how much further down this last little pullback will go. I don't think it's very far, but if you're a short-term trader, you need to do something about it. But if you're a long-term investor, there's no need to do anything. So that's why it's so important to know who you are, because it really determines what sort of action you should be taking right at the minute. Now, this is just another chart. There's a number I could show you. And what it's showing is the net on a rolling 12-month basis, the net flows of funds into mutual funds in America, or the main managed funds. And you can see that with the exception of a brief period in 2013, early 2014, that they've been negative on a 12-month rolling basis. So funds have been net flowing out of the market since 2007. So that backs up my point factually with the fact that, a lot of money is in the market. Money's been coming out of the market. So there is just no way that we can get a top and a bear market under those circumstances. So, bear that chart in mind the next time you read an article by someone who's trying to, grab the headlines by scaring the pants off you. So, look, it's a rapidly shifting picture. This is a chart that I put up last week, or a slide I put up last week. On a big picture level, this is an excellent environment for stocks. We've got slow and stable economic growth, and therefore no excesses. We've got reasonable to very attractive valuations for key sectors and stocks. Not across the board, but in key sectors, the valuations are still really quite good. We've got low interest rates all around the world, with no prospect at all of interest rates rising in any country except the US. And I think in the US, any interest rates we get will be, pretty much a one and done situation. We might get a 25 basis point rise, and then that might be it for a period of time. The Fed will put their queue in the rack for a while. So no real prospect of significantly rising rates. Substantial cash levels must now play catch up. A lot of fund managers acting out of self-interest are going to be forced to chase this market into the year end because others will be, and they'll have an eye to what their bonuses look like. So don't underestimate that dynamic. Now we might have another week of downward direction in the market, but we can then still see a strong rebound into Christmas. So turning to American stocks, the S&P 500 in perspective, and I'll get to the chart in just a minute, was up 13% in 6 weeks, and it was down 3.5% last week. So, let's not overreact to what happened last week, even though those declines in the last 2 days were reasonably abrupt. The index finished down by 76 points on the week, sitting right on a key level at 2020, and there are two other levels below that I'm watching, 1993 and 1964. But the key to me is how markets react around the all-time highs. So once we get back above the 2100 area, how the market reacts around there. So let's take a look at the S&P. So you can see Thursday and Friday really were quite sharp, but then equally so was this period here during October. Now we sliced straight through this support at 2047, which is a bit disappointing, a bit surprising, but I've put a Fibonacci retracement scale on this run, which started on the 29th of September and ran into early November. The 38.2 level is 2020, and that's where the market finished on Friday night. We then have a 50% retracement to 1993 and a 61.8% retracement to 1964. Now, I just want to go back to 2011 because this correction is a very, very close blueprint to what happened in 2011. So you can see we went into a correction in early August, whereas this time it was late August. Market went sideways, formed a slightly lower low, which didn't happen this time, but broadly pretty much the same, and turned around on the 4th of October. This year, I think it turned around about the same day. Now, we got a very sharp rebound, and then we got a pullback to guess where? Exactly the 61.8% level, before we then got a strong rebound. So this takes us to early December. So this low here occurred on the 25th of November. We then bounced hard into early December. We then pulled back again briefly for a week or 10 days, and then we were off to the races, and the market went up strongly all the way into April. Now, there's been a huge number of similarities between 2011 and 2015 in the US market. So if that continues to follow that blueprint, then this is pretty normal. We could pull back potentially to 1964, but I would, until that level breaks, or if that level breaks, then I'll still sticking to my view that we'll just see a consolidation period and ultimately a break to new highs above 2130. So that's the way the American market is shaping up at the moment. Turning to the Australian market, the Aussie dollar, it's just bouncing around in the 70 to 72.5 range at the moment. No real changes. The US dollar is showing strength, and the Australian dollar is showing some relative weakness. The ASX 200 index down by 165 points on the week, and we saw miners break to new lows. That was largely around BHP with their problems in South America and Brazil. So new lows below the GFC lows, and all other sectors were also under pressure as well in the Australian market. Let's just take a quick look at those charts. First of all, we'll just look at the US dollar index. Haven't looked at that for a little while. So you can see we had formed some downsloping peaks in the US dollar, and clearly broke through there on the 4th of November and is continuing to the upside. I would expect another assault, particularly if the Fed raises rates in December. I'd expect another assault on this 100 level, and depending on what it does around there, we then could move ultimately. You can see the all-time highs back around the 120 mark against the basket. Just looking at the Australian, the Aussie dollar, there it is in this range between 69.6 and around 74, and it's sitting pretty much in the middle of that range. The Australian market, I'll look at the materials first. So you can see we broke these recent lows here, and it's been a long time since we were down at these levels. So there's November 2008. So we haven't quite broken the 2008 lows on the index, but BHP certainly has. BHP traded below $20 during the week, which is certainly a new long-term low for them. There's the ASX 200, not really showing any signs of bouncing there at all. Turning now to commodities, gold was a little bit lower, $6 for the week. It has broken long-term support, not by much, and gold stocks are still doing very little at this stage. So let's look at those few charts. This is the US dollar on a daily basis, so you can see it really just dribbled down a bit. But there's the weekly, which does show that long-term trend line, which really started in 2006, has now been breached. We've got a support level at about 1,020. So things not looking at all good for gold. Copper dropped to $2.20. Certainly part of that is the US dollar strength, but part of it would also be just general weakness in commodities. And crude oil was down 8%. That's a big drop on the week, down to $41, and that really is concerning because people take that as a real sentiment indicator for the rest of the market. And crude oil, there was some key support around the 42, 43 mark, so that's been broken again. So energy stocks still remain under pressure. There's the spot copper chart. You can see the quite sharp decline that we've had since the middle of October. So not looking good, and new lows in copper. And just to expand that out a bit, this is the 30-day copper chart. showing you the decline from around 242 down to just under 220. So quite a significant change there in the copper price, down around about 9%. So just to wrap it up, the overall strategic approach, my view remains this: the bull market is still intact for the reasons that I've just elaborated over and over again. However, I think one should always have an alternate strategy in mind. You must remember we're in the 6th year of a bull market. We're getting towards some of the historical extremes. That in itself, it doesn't mean that it needs to stop, and I think that's what some of the bearish commentators are seizing on, the fact that it's been going for so long. Well, I mean, that's not a reason. That's just an observation. To my way of thinking, there are no circumstances in place for a bear market to start. So the bull market is intact, but we should at least be open to changes so that we don't get caught out. This pullback is normal. We've had a strong run up. To get a pullback from all-time highs is quite normal. But stock selection absolutely vital at this point in time, because there is a massive divergence in the performance of different sectors, particularly in America, but also in Australia as well. So that wraps it up for this week. These are tricky times now, and if you're out there trying to do this on your own, then there's a lot of support I can offer you, and perhaps a really useful perspective that I could offer you as well. So there's my contact details for any non-members, and we'll see what next week brings. I'm sure it'll be as equally vibrant and interesting as the week we've just had. So that's it till next weekend.